Good evening, class, and welcome to advanced taxation class for ICANN exam. My name is Chima, and I am your host for tonight. Last class, we discussed the pioneer legislation, and we talked length about the theory parts, the discussion class. Today, we will be going straight to the calculation part of the whole thing. And let's look at some questions and see how we can tackle questions on pioneer legislation. Now, if you are given a calculation problem in pioneer legislation, know that you are either going to be tested on cessation rule or the commencement rule. So take this as a bonus for doing cessation or commencement rule. Now let us look at question number 1. This is like a typical question that can come in your exam. The question here says, New Idea Processing Company Limited was established in 2008 and commenced its cocoa processing business on July 1 in the same year. The adjusted profits of the company are as stated below. Now, this is the period to September 2009. So it's obvious here that the account year end is September 30. And this is a loss, this is a profit, and a profit. Now we are told that capital allowances for the relevant years of assessment were computed and agreed with the Federal Inland Revenue as follows. 2008 year of assessment down to 2012. Now, one thing I should tell you as a hint is that the period of capital allowances will give you a hint on the period or the relevant years of assessment that the examiner wants to calculate. So if I were you, I would take note of the years of assessment for the capital allowances, and that will be my hint for the year of assessment the examiner is asking for. Now, why is it that way? This is because capital allowances are always presented to us in year of assessment, whereas profits is stated in account year end, which I will call our basis period. And you will not be the one to convert the basis period to an appropriate year of assessment. So you can see here that capital allowance starts from 2008 down to 2012. And that's a relevant period. Now, the question says, determine the tax liabilities for all years, all relevant years. Now they said, please note that the company was denied pioneer status. Now, this is one way that the question could be coined. Now, the key word here that makes us consider it in pioneer is because it was denied pioneer status. And since there is a denial, there was nothing indicated in the question the production date. But if you were given a production date and the requirement tells you that the pioneer status was cancelled, you will need to know the date in which it was cancelled. And if it is less than 12 months, take it back to the anniversary should be the production date. So it is as though the company had not been a pioneer company. But if the company had enjoyed over 1 year of pioneer status before it was cancelled, we know the cancellation is deemed to have occurred at the last anniversary. Now, in this case here, the company was denied pioneer status. So it means they have applied, but it never enjoyed pioneer status. So we will treat it as a pure commencement of business question. Now, take note here that in commencement of business, we need to know whether it falls during the era of Finance Act 2019 or before. You can see here that it is before Finance Act 2019. So in order to solve this particular question, we will have to solve it the way it was solved in the era before Finance Act 2019. I told us that before that era, we will need to establish the date in which the business commenced. So I'll take this question, New Idea Processing Company Limited. Let's take it down to where we will solve it. Take it to this page. So this is a question number 1. New Idea Processing Company Limited. Okay, so that's it. Just a moment. All right. Good. So we are asked to look for the tax liability for relevant years. So I will say computation of tax liability for years of assessment 2008 to 2012. Now, I got my hint from the capital allowances. All right, so I'm going to do some preliminary notes. Let me see. Preliminary notes. Say dates of commencement. What's the date of commencement here? We are told the business commenced on July 1, 2008. So I will say this is July 1, 2008. Then I will say account year and date is September 30. That's for every year. Okay. All right. So let's see how it's going to be. We will now look at the first year. So I'll arrange it this way. Year of assessment, basis period, then I will say description I will say description, and I will say notes, and I will say amount. And this is going to be in Naira because it is a Naira transaction. I'm going to underline all of these here. These here. This, and this. So let's go. I can come here and say this is going to be 2008. This is going to be 2009, 2010, 2011. What am I doing? Okay, let me not do it that way. Okay, so let's leave it as 2008 first. And let's treat 2008. Okay, so we will start. All right, basis period here. Now, I said that for the Pre-Finance Act, let me call it here, Pre-Finance Act 2019. So in the Pre-Finance Act 2019, your first year, the basis period will start from the date the business commenced. So I will say this is going to be July 1, 2008, and it will take you all the way to 31st December. 31st December 28. So it's going to be an actual year basis. So it means it starts the year in which the year of assessment is. The year of assessment is coincide with the year the business starts, and it ends at 31st December of that same year. It doesn't respect the account year end. So that's it. So what I'm going to do here is I will say this is my adjusted profits, adjusted profits, I'll say or loss, because I have a loss here. But now I have a period from, so this period, let's identify what this period is. So this period started from July 1, 2008, and it's ending in September 30, 2009. So let's count from July 1, 2008 to June 30, 2009. It's going to be 12 months. So from July to September, July, August, September. So that's another 3 months. So that's going to be 15 months. So this period is 15 months. So that is what this period is. It's a 15 months period. And now, what are we going to do? Let's take our notes here. So we're going to do note 1. So I'm going to give this plenty of space. I'm going to give it 2 pages, and I will start my workings here. I will say notes. So this is note number 1. Adjusted loss. Okay, so this is year of assessment 2008. So you say loss for the year. How much was given? This is 600. And how many months period between July to December? Because this is a 2008 year of assessment. We say it starts from July 1 to December. That's a 6 months period. So loss for the year is simply 6 months, which this basis period covers, out of 15 months, and we have 600 here, divided by 15 times 600,000. So what would that give us? Let's activate our calculator now. 15, okay, so sorry. 6 divided by 15 multiplied by 600,000. That will give us 240,000. So I will put my 240,000 here. So this is going to be a loss. So I'm going to take it all the way up and bring my loss to be 240. 240,000. And that's a loss. We are going to be carrying it forward. Then we are going to bring our capital allowances. We say capital allowance carried forward. Because we are not relieving the capital allowance, we are going to be carrying it forward. Okay. Now, because we are dealing with capital allowance, we want to know the kind of business this person is dealing. It's a cocoa processing business. It's a manufacturing company, and so capital allowance not restricted. So that's one thing you should know, because this is a processing company. Capital allowance is not restricted. So, but we are going to take the capital allowance and take it to the next year. We have taken this now. Capital allowance is 750. So we'll take it down here, 750,000. So capital allowance is not carried. So we'll go now. Total profits. Total profit is nil because we had no profit, we had no loss. So total profit is nil. Then CIT at 30% is also nil. Tertiary education tax at 2% at that time is nil. So we've done with this particular year of assessment. So let's take this down again. Let's take this down. Let's see how far we can go here. I'll end it here. Okay. So we are adjusting our lines as we move. So let's adjust our lines. So this is going to be, let's just adjust our lines so that it will take us. All right, so let's go. The next year is 2009 year of assessment. Now, this is the second year. According to the law, the tax law, the second year, we are going to go back again to the date the business started, which is which is July 1, 2008. And we are going to take 12 full months. So it means the second year, we are considering the first 12 months in business. first 12 months. So this is going to be ending here in 30th June 2009. 30th June 2009. Now, going by what we have here, we have September 2009 ending. So we're supposed to be taking the sorry, I've got a call that disconnected me. I will need to share my screen again. Just a moment, I'll share my screen. All right. So we are on the second year, and we have identified that the second year, we are going to start counting from the date of commencement of the business. We'll count the first 12 months. And now it still gives rise to loss. So we'll bring our adjusted loss. We'll now go to workings 2. I call it note 2. I'll go down here. Note 2, adjusted loss, year of assessment 2009. So I will say loss for the year. Loss for the year. We are going to be taking 12 months because we said it's 12 full months. Remember, we started the business July 1, 2008, and our 12 months is still within the 15 months. So we are taking 12 over 15 times 600. So if 6 months will give you was 480. That's going to be 480,000. Okay, 480,000 is the loss for the year. So what do? We will say adjusted loss is 480,000. Then we'll look at loss brought forward. That was 240,000. If we add the loss available here, this is 4 plus 2 is 6. So this is going to be 720,000. Can you see now that the loss here is even more than the actual loss? It's even more than the actual loss. And the thing again is, this 240 we have here is included in this 480. So this is not the actual loss for the year. So we are going to say actual loss. Actual loss. The actual loss is this 480 because we have just taken only 12 months loss out of the whole 15. So it is not as though we are having 240 separate loss from a different period from this 480. The period covered in this 240 is also covered in this 480. So there's no basis for adding the two of them. So we're going to take it as 480. That's what we learned in our loss relief class, that your actual loss, your loss to be claimable will not be more than the actual loss. And this is the actual loss. That's the actual loss. Let's draw our lines more. So this is our line. I pray this line will carry. I pray it carries. Let's see. If it doesn't carry, we will make it carry. Forgive my ruling. There's no line here for me to measure and rule. So just forgive what you have here. All right, so our actual loss is this. Then you will now have to bring your capital allowances now. Capital allowances. Capital allowance for the year. The capital allowance for the year, we are told, is 600. So we are going to take this 600 now. Capital allowance for the year is 600,000. Capital allowance brought forward. Remember, we had 750 before. We are now bringing the 750. When you add them, 7 plus 6 is 13. That is 1,000,000 350. 1,350,000. So this is your capital allowance carried forward. So we have your total profit is still new. So that makes your CIT at 30% to be new, and your tertiary education tax at 2% to be new. This brings an end to this year of assessment. We'll go to the next one, 2010. Okay, so let's just a moment. All right, so for 2010, which is the third year, that is when we start doing preceding year basis. So in this year, we are going to be doing preceding year basis ending on the account year end dates. So what it means is that this is 2010. Since it is preceding year basis, it's going to end in 2009. And it's going to end on our account year end. So what it means now is we are going to say this is going to be 30th of September 2009. So that is what we know here. September 30th is our account year end. So since it is preceding year basis, it's going to be 2009. It's going to end on September 30th. It means that this must have started in October 1. October 1, 2008. So in October 1, 2008, just a moment, I have an issue with my lighting. I'm back. So in October 1, 2008 to 30th September 2009, that's going to be 12 months. So I'm still going to come here. Instead of doing the same calculation all over again, I'm going to rely on this same calculation because it's going to be the same 12 months. So I will just come here and I'll update my workings here to be 2009 and 2010 because the same working I'm going to be using. So I have how much there as my figure? 480. So that's what it's going to be. Adjusted loss. I'll say workings 2, 480. Okay. Then loss brought forward. What was our loss brought forward the last time? Was this actual loss of 480? I'm going to bring it down again. 480. When you add the two of them, this is going to give us 960. Now, this is 960. And what happened here is this. This 480 contains the loss from July 1 down to June 30th. July 1, 2008 where the business started, down to June 30th, 2009. That is this last one here, but this first one started from October 2008 to September 2009. So there is an overlapping period of this loss. There is an overlapping period, which is from October. Both of them have October to December, October to June. There's an overlapping period of October to June. So if you look at it now, October, November, December, January, February, March, April, May, June. That's like 9 months. Let's do something smart. Let's do one smart thing. Maybe this is 9 months. Let's see something here. 9 divided by 15 multiplied by 600. It gives me 360. 360. Okay, so it's not even 9 months. Let's look at this period. This period is October 1. All right, October. So we have June, okay, July, August, September. It's only 3 months that is not even here. So this period here is just a 12-month period. The period that is not lapping, let's do something again. The period that was not lapping is 9 months. Let me divide this by 3 to get 3 months. Yes, this is what I was looking for, 120. This 120 is the period that was not lapped, that is not. So it means that this 480 contains October to September. This 480, out of this 480, 360 of it is inside here, which is from 360, this 480, 360 is from October to July, to June. That's the 360 we calculated, which we calculated at 9 months, which is this one we calculated 9 over 15 times 600. That's the 360 that is inside this 480 here. So it means that this 480 contains 360 here. The 120 that is not here, coupled with this 480, these are the actual loss. Suffice it to say, just not to bother your head in this calculator, we have covered this whole 15 months during a 3-year period. And so what it means is that your actual loss, you can always come here and say 480 plus 120. You know, I got this 480, this is the loss for the year. The 120 is, you can decide to break it further. Instead of just saying 120, you can say plus 480 minus 360. It's still the same thing as 120, because this second one, 480, we are removing 360 that we can find here, and it's only 120 that is remaining. So that will give us 600. So 600 is the actual loss. And if you notice, it is the same 600 that is for this period. And it is being considered for these 3 months, for these 3 years. The capital allowance is going to be 700. So let's take the capital allowance here. So this is your loss, 600. Capital allowance for the year is 700. Then capital allowance brought forward. This is 1,350. Add them together is going to give you 2,050. This is the capital allowance you are taking to the year 2011. So suffice it to say here, total profit is nil. CIT at 30%, nil also. Tertiary education tax at 2%, nil. This brings an end to this year of assessment. We'll go now. This was not even enough. What I will do now, let's, for the sake of this class, jump to this place to do it. Let me say the next one is year of assessment. This is going to be 20. We just did 2010. So now let's do 2011. This is going to be 2011. The basis period. Basis period. Of course, now this is preceding year of assess. Preceding year basis will now go. So it's going to be October 1, 2009, where the old one stopped, to 30th September 2010. So this is a description here. Description. This is assessable profits, because we made a profit here of 1.5 million. Okay, see it's here 2010, 1.5 million. So these are our notes. These are Naira amounts. This is 1.5 million. Okay, then you will bring your loss brought forward. The loss brought forward, we say it was the actual loss of 600. 600. So when we do it here, this is going to be our adjusted profits. So this is going to give us 900. 900,000. 9 plus 6 is 15. Okay, so that's 900,000 profits. Then we are going to bring our capital allowance for the year. Capital allowance for the year is given to us at 550,000. So let's do it here. 550,000. Then capital allowance brought forward. We have a capital allowance brought forward from last year. We have it here to be 2,050,000. So we're going to bring it down here. 2,050,000. So let's write that 2,050,000. When we add all the capital allowance, somebody's asking a question. Let me see what it is. Somebody say, I don't understand, please. So when you say I don't understand, please, I don't know where you don't understand, so that I can understand your question and try to answer. Where do you not understand? So can you unmute and talk so that I can go to that point? While I'm waiting for you to unmute, I'm going to complete.
Yes, Mr. Chima.
Okay, talk to me.
Please, can you go back to the questions?
Okay, this is a question.
Because I don't really get the question, so I was just following the first. This one, this first one you are doing now. Are you joining it with the second this thing that is down?
I didn't
The
get that.
assessment. This period that this adjusted profit that they gave us that is stated from period to September 30. I think this is the first one you did.
This
Is
one
it the
here,
September? Is it the September 30, 2009 that you did to 2010, or you continue? I don't understand. The thing is
I
somehow
don't understand your
confusing
question
because
also. I said, because I cannot write here. Normally, these notes are not supposed to be here. I jump as if it is a continuation. I continued
okay.
it here. It's not a different question. We have
Ah,
just done
I,
2010. 2011 cannot contain here. So I
okay.
jumped to this page to do
But that
2000.
2009 that they gave us, the assessment profit was assessment profit is 600,000.
It was not a profit. They didn't give us 2009. They gave us, I told us that this is not accessible year. This is
Okay.
year of account year end. And I
Okay.
told us that your capital allowances helps us to know the accessible year of assessment rather. And
Okay.
I told us also that this is pre-Finance Act 2019. So in that period, what they normally do is that the year the business commence becomes the first year. So it means your first year of assessment is going to be
2008.
2008.
Yeah.
What will be the basis period for 2008? It will be the date the
Be-
business started, which is July 1,
Like 2008
2008. And it doesn't
to
matter where you end your account year. It must be actual year ending in
that
31st
same year,
December
December
2008.
2008.
Good. And that is what I have here.
Okay.
Okay. Then,
Okay.
if you calculate this period, this is 6 months. This is 6 months. And that
Yes.
influences why, when we are calculating, we use 6/15 because
I understand what this one.
good. Then we said the second year, which is the year of assessment 2009, how it is being done is they will go back again to the date the business started, July
Okay.
1, 2008.
Okay.
And they will count 12 months from that date. So July,
Okay.
yeah, the 12 months will end will be June 30,
Okay. 2009.
2009. And that's what I have here,
Okay.
2009.
Okay.
And you see, it's still in this same period because this is September 2009. So June 2009 is even here. And that is why
Okay.
I took 12 months out of 15. If you look at the
Okay.
working, I took 12 months out of 15.
Okay.
Now, for year of assessment 2010,
2010.
that is where the
Okay.
preceding year rule starts.
Starts. Okay, sir.
Preceding year rule now says that you must end on the account year end, which is 30th of September. And since this is 2010 here, the year must be 2009.
2009.
And it has to be 12 months. So it means that it must have started on October 1,
2008.
2008. And that's what I have here.
Yeah. Okay.
And This is a 12 months period, which is also in this same bracket, because you can see this is September 30th, 2019, 2009, and this is where it ends. So the 12 months is inside here. Since I have calculated 12 over 15 here, I don't need to come and write it again. So that's why I came here in my workings and I said this calculation will serve for 2009 and 2010 because it is exactly the same thing I'm going to be writing.
Same thing. Okay, sir.
80. And so that's what I got here. Now, if you look at it again, this is the first one I calculate 6 over 15. This is the second one, 12 over 15.
12 over 15.
Third one, 12 over 15.
Over 15.
Now, what I also did here is, this is 6 months, no problem. The capital allowance is carried forward. You understand that? This is
Yes.
the second year. This is 12 months. And we are bringing that 6 months that we have in the first year to the second year. But we said,
okay,
this 12 months, this 6 months is inside this 480. Do you know why? Because look at this 12 months. It started from July 2008 and it ends in June. But look at this one, July 2008 to December. They are all inside here.
Yes, sir.
And so that's why we said this 240 is inside this 480. And so this 720 that it gave us to is not the real loss. The actual loss is this 480 because this 240 is inside it.
Inside it. Okay.
Then we have 600 capital allowance and we add it with this 750 capital allowance. It gives us 1350, which we cannot do anything about it. You have to carry it. Then in the next year, which is 2010, and we said the same calculation for 29 is the same calculation for 2010. So this 480 is the same calculation we did and we got this 480. That's this 480. But now, what is this second 480? It is this actual loss here that we brought forward here. But now the thing is this, 480 plus 480 is 960. But what is the actual loss? If you look at this one here, this one has some dates that this one does not have. If you look at this, this one started from the date the business commenced, July 1 to how many? To June, right? So what can we find here? We cannot find, we cannot find this July here. What we can find, we cannot find July, we cannot find August, we cannot find September.
By September.
October, look at this October. From October inside this month, from October down to June the next year, can be found here.
Yes.
Only 3 months cannot be found. And that's why we said this 480 is this one here. This 480 is this minus the remaining 9 months we can find here, because we cannot find 3 months, which is like 120. So if we remove the 360, the 9 months we find here, it's going to give us 120. 120 plus 480, it gives us this 600, which is 600. The same 600 we have been using. So imagine that if this is a real business, and if this was to be a profit, it means this profit will have gone to tax 3 times. But you see now, it was a loss. A loss, we now take actual loss, which is 600. All right, that's what we did, which was this 600. And we bring our capital allowance for the year, and the accumulated capital allowances became 2,050,000. We now go to, you now understand, right?
Yes, I understood. Thank you, sir.
We now go to 2011, And we say it's going to be preceding year basis, ending on the account year end. So it means this is 2011. The end date must be 2010, and it must be September 30th. So it must have started October 1. Which account year ends in September 30, 2010 is this, which is 1,005, 1,500,000. That's how we got it. But remember, we are to bring our loss from the previous year, which was actual loss of 600. And when we deduct the loss from the profit, we are left with adjusted profit of 900. Now, our capital allowance for the year is 550. What we have been accumulating up to this time is 2,050,000. So when we add that, this is what we are about to do. We add that, is going to give us 2,600,000. 2,600,000. So this is your capital allowance claimable, or capital allowance due or claimable. Now, how much are you going to claim? Remember, I said this is a processing company. There is no restriction on capital allowance. So what are you going to do now? You are going to say your capital allowance claimed is going to give us the whole of this 900 here. So this whole 900 will be claimed here. Put brackets here. Come here again and put bracket 900. So this means here that what is the balance of capital allowance you are carrying forward? It's going to give you 1,500,000. No, 1,700,000. 1,700,000. So this is your capital allowance carried forward, right? 1,700,000 is carried to 2012. And what is going to happen here? Your total profit is going to give you nil, because 900 minus 900 is nil. But your CIT at 30% of total profit is also going to give you nil. Meanwhile, your tertiary education tax at 2% of adjusted profits or accessible profit. So now, this first one here is where we base our education tax. So 2% of 1,500,000. So we'll come here, 2% of 1.5 M. What would that give us? 2 divided by 100 times 1,500,000. That'll give us 30,000. So our tertiary education tax here is going to give us 30,000. And so that ends for this year. Then the last one is going to give us year of assessment. It's going to be 2012. Okay, 2012. And that's going to be from October 1, 2010 to 30th, 31st, okay, 30th of September 2011. And if we look at it now, it's going to give us accessible profits of 2,750,000. 2,750,000. So we'll take it here, 2,750,000. All right. There is no loss that will be carried down, because no loss from that year. So no loss. All we need to do now is capital allowance for the year. for the year. Capital allowance for the year is going to give us 480. So we'll take it down here, 480. Then capital allowance brought forward. Brought forward will be from what we have here, 1,700,000. So we have 1,700,000. Okay, now when we add that together, it's going to give you 7 plus 1. 7 plus 4 is 11. So it's going to give us 2,180,000. So that's going to give your capital allowance due. So now your capital allowance claim is going to give you, we are not going to restrict. So what you'll be doing, because you're not restricting, you'll be looking at the smaller between your assessable profit and your capital allowance. Which one is smaller? The capital allowance is smaller, so you can take everything. 2,180,000. Take it down here. Unlike the previous one, where the assessable adjusted profit is smaller than the capital allowance due, we took the smaller. Yeah, we will take the smaller. So this is going to be 2,180,000. So there's no need carrying forward because this is done here. So this 2,750,000 minus 2,180,000, what will that give us? 2,750,000 minus 2,180,000. That will give us 570. So that's it. 570. 570. So that's going to be your total profits. 570. So your CIT at 30% of total profit is going to give us 30% of 570. So let's times it by 30. It's going to give us 171. 171. So this is going to give us 171,000. That's the tax. Tertiary education tax at 2% of assessable profit is going to give us, what was that? 2,750,000. So it's going to give us 2% times 2,750,000. So what would that give us? 0.02, that's 2% times 2,750,000. That will give us 55,000. So that is 55,000. And that ends this question. So we said pioneer legislation is as good as your basis period, commencement rule, cessation rule. Now let's see if we can do one more question and we call it a day. All right. Jade Nigeria Limited was incorporated in March 31. Okay. On, what's this? Maybe they are asking, okay, was incorporated on March 31, 2014. Now, date of incorporation is not important. To manufacture a pioneer product, so now this is a pioneer product. It was granted a pioneer certificate with production date certified to be June 1, 2014. So what did I say? Production day 1/6/14. When is it going to end? End. Initial end. Initial end. Okay, let's do the workings there. Let's look at it as preliminary workings. So you are given the following information: net profit for the year, this and that. Okay. It is not the intention of the directors to apply for an extension of the pioneer period. So it means that the pioneer period just ended and they are not having any interest of pursuing the extension any further. So what do? They say compute the tax liabilities for the relevant years of assessment. So this is the question here is Jane Nigeria Limited. So let's take it down here, Jane Nigeria Limited. So that's question number 2. Jane Nigeria Limited. Okay. Computation of tax liabilities for year of assessment, we don't know yet. All right, we'll start with preliminary notes. Preliminary notes. You say date of incorporation, which is not important. Date of incorporation, 31st March 2014. I'll say not important. Then production date. And we said it is June 1, 2014. June 1, 2014. Initial pioneer status end dates. So we are going to looking at it that since it started in June, so it must be ending in May. So it's going to be May 31st, but it started in June to be ending in May. And this is 2014. Add 3 years to 2014, it will be 2015, 2016, 2017. So it's going to be 2017. So this is the dates the pioneer is going to end. And this is all for old business. So this is old biz, which is pioneer. So I will now say new business post pioneer. New business post pioneer. Date of commencement. Commencement is going to be the next day after pioneer, which is 1st of June 2017. Then were we giving account year end? All right. Net profit for the year ended May 31st. So account year end is May 31st. Therefore, first account year end. So it's going to be from June to May. It's going to give you 31st of May, 31st of May, 2018. That will mean that your first year of assessment is going to be what? It is going to be what? Now, this changes everything. Date of commencement is 2017. This is pre-Finance Act 2019. And so your account year is May 31st. Your first account year end, of course, is going to be this. But your first year of assessment is going to be 2017. It's going to be 2017. So that's it, because this is pre-Finance Act. Even though your first account year is ending 2018, that is basis period, account year end. But year of assessment, according to the tax law, is 2017 because the business started in 2017. And so your second year of assessment is going to be 2018. So 2017 here will be from June 1, 2017 down to 31st of December 2017. And here will be 1st of June 2017, same date with this first one, but it's going to be 12 full months. 31st May 2018. Okay, then the third one here, year of assessment, is going to be 2019. And you know it's going to be on preceding year basis, ending on the account year end. The account year end is 31st May. And since this is 2019, it means it has to be 2018. Wow. And it's going to be 12 months, so it's going to start from June 1, 2017. So it means your year 2 and your year 3 are exactly the same thing. Now that's it. So we have 3 years to contend with. So we have 2017 to 2019. So we'll come back here and say year of assessment 2017 to 2019. All right, so how do we do that? We'll start. Old business, pioneer business. So we want to give our performance report. Now say period June 1, 2014. Did they give us year by year period? Accumulated profits. Let's see what we were told. The pioneer is going to end when? Pioneer is going to end 31st of May 2017. And when you say accumulated profit as at 31st May 2017, which is this date here, it means this is for pioneer. So this is pioneer profits. Pioneer profits from June 1, 2014 to 31st May 2017. So this is the profit that was accumulated. They didn't give us year by year. So all I will just do now is I will take it as accumulated profit. So period June 1, 2014 to 31st May 2017. I'll say accumulated profits. Accumulated profits. How much is that? 725. 725,000. This is your profit. Capital allowance claimable. It's got to be nil because you don't enjoy capital allowance. So total profits is going to be 725,000. So company income tax as well as tertiary education tax are going to be nil. Tax relief or holiday. So we don't tax this business. So this is for this is the pioneer period. So that's it. We come to new business. New business. This is post pioneer. Okay. So this is a new business. So we start with the first one. This is year of assessment 2017. And we said it's going to be from June 1, 2017 down to 31st of December 2017. How many months is that? This is 7 months. This is 7 months from June to December. That's 7 months. All right. We are giving net profit for the year ended. So it is specifically say year ended, not period ended. It means this year would have started from June 1, 2017 to 31st May 2018. This is 1 year, 12 months, which is 12 months. And now we are taking a portion of it from June to December. We're going to be taking 7 months. So we are saying accessible profit. Let me write my accessible well. Accessible profit is going to give us 7/12 multiplied by this figure 1540. 1540,000. So let's do that here and get our accessible profit. 7 divided by 12 multiplied by 1540. That's going to give us, wow, this is a funny figure. Let's calculate again. 7 times 1540 divided by 12. Still the same figure, 898333. 898333. So I'm writing 898333. So that's the accessible profit for that year. So I'll come here, capital allowance. So I'm going to jump these 2 lines and go and do my workings. Workings. 1, capital allowance for year of assessment 2017. All right. All these qualifying assets that was bought and all that, if you look at it now, depreciation charge for the year is this. We are, I have done something wrong. We are supposed to have added back the depreciation. We're supposed to have added back this depreciation because depreciation is not supposed to be chargeable. So let's go back and adjust our calculation here. Your adjusted profit is going to be 1,540 I'm going to add plus what we have in depreciation. One, is it 13,000? I want to believe is 132, 140. I want to believe that 132, 140, 132, 140. So let's do it again. 1,540,000 plus 132, 140. That gives me this, and I'll say times 7 divided by 12. And that gives me a figure 975,415. Let's look at it that way. 975,415. $975,415. Now your capital allowance, we are going to take all these assets here, this, and this, as being purchased on the first day of the new business. So I'm going to look at them: motor vehicle, plant and machinery, industrial buildings, non-industrial buildings. So I'm going to go here. I'll look at one by one. Motor vehicle, I'll call it MV for motor vehicle. Plant and machinery, I'll call it PM for plant and machinery. Industrial building, I'll call it IB. Non-IB, NIB, and I'll call this total. All right, the stage is now set. All right, so let's calculate our capital allowance. So what we'll do now, we are going to be looking at the rates. So we have your initial, okay, let's start with investment allowance. Investment allowance, this is dash, this is 10%, this is dash, this is dash. Initial allowance rate, motor vehicle is 50%. This is also 50%. Industrial building is 15%. This is 15%. Annual allowance, this is going to be 25%. This is 25%. This is 10%. This is 10%. Now that we've got the rates on the way, we'll start. So this is for 20, what's the year of assessment? We are dealing with 2017. 2017 year of assessment. All right. So we are going to say costs. What are the costs? 1,250. I'm going to write it here. 1,250,000. The next one is 1,425. 1,425,000. The next one is going to be 1,890. 1,890,000. And the last one is 920,000. That's going to be 920,000. So we'll start with investment allowance. Investment allowance is going to be 10% of this, which we will not put here. We'll put it down here. It's going to give you 1,425,500. Because investment allowance will not reduce the tax written down value. Then we go initial, this initial allowance. Initial allowance, 50% of this is 625. 625. Then here will be 715. 715,000. I will need to verify them. This is going to be 945. Okay, sorry, 15%. Let's verify these other ones first.
715 is not correct.
We are checking them now. 0.5 times 1,250 and 625. All right. 0.5 times 1425. 712,500. Yeah. 712,500. 712,500. Now let's look at 15%. 0.15 times 1,890. That gives me 283,500. 283,500. So let's clean. 283,500. 283,500. Then we'll take the next one, which is going to give me 15%, that is 0.15 times 920. That's going to be 138,000. So I'm going to mark it here. $138,000. Now, when I add all of this, what will I have? 138 is here, plus 283,500. Sorry, 283,500 plus 712,500 plus 625. That gives me 1,759,000. 1,759,000. 1,759,000. Now, this is all initial allowance. Your annual allowance is going to be as follows. Now, let's do them one by one. Annual allowance here, we have the first one, 1,250,000 minus 625,000. That's going to give us 625,000, right? Now, 25% is equivalent to 4 years. How do we know? We learned that for you to know the number of years, it is 100 divided by the annual allowance rate. So 100 divided by 25 is 4. So 4 years. So this 625,000 remaining is going to be useful or is going to be claimable over 4 years. So I'm going to divide by 4. That means this is the amount for 1 year. 156,250. 156,250. But now for this first year, I'm not going to use 156,250. You know why? Because I didn't use 1 full year for the period. I used 7 months. 7 months, right? 7 months. So what I'm going to do here is I'll just say multiplied by 7 divided by 12. So I'm going to charge 91,146. 91,146. So I'm going to charge 91,146. Is that it? Yes. Now look at the second one. I have 1,425,000 minus 712,500. I have that. Now 25% is still 4 years. This is what I will charge in for 1 year. But I use 7 months. So I'm going to multiply by 7 divided by 12. And that's going to give me 103,906. 103,906. So this is 103,906. 103,906. Now the third one, I'm going to do it this way. 1,890,000 minus 283,500. That's going to give us 1,606,500. Now 10% is 10 years because 100 divided by 10 is going to give me 10. So I'm going to divide by 10 years. So this is what I'm going to be claimable for 1 year, 166,50. But I'm going to take 7 months. Every of this item here is for 7 months times 7 divided by 12. So that's going to give me 93,713. 93,713. 93,713. Then I'll do the last one. 920,000 minus 138,000. That's going to give you 720. Now I'm going to divide by 10 years because it's 10%. 10 years. That gives you 78,200. I'm going to look for 7 months out of it. 7 divided by 12. So I'm going to get 45,617. 45,617. 45,617. So what I'm going to do now, I'm going to add all of these together. 91,146 plus 103,906 plus 93,713 plus 45,617. It gives you 334,382. 334,382. Now I'm going to get my total capital allowance here. So let me add the total capital allowance. I have this last one here. I will now say plus 1,759,000 plus 142,500. 142,500. I have 22,35,882. 22,35,882. And that's what I'm going to take down. Capital allowance 22,35,882. So this is your capital allowance due. Okay. And now this is a pioneer company and it's a manufacturing company. Manufacture a pioneer product. So because it's a manufacture company, capital allowance not restricted. So you go here, your capital allowance claimed is going to give you the smaller of the two. So it's going to give you 975,415. So this is your capital allowance claim. 975,415. All right, so capital allowance carried forward. What will that be for us? This is what we have as our capital allowance. We are removing the one we claimed, 975,415. So, it's going to be 1,260,467. This is what we are going to carry forward. And so your total profit is going to give us nil. So that's nil. And your company income tax at 30% of total profits is going to give us nil. Tertiary education tax at 2% of accessible profit is going to give us 2% of this. So we calculate 975,415 times 0.02. That gives me 19,508. 19,508. So that's for 2017. We close that out. Remember, this is the pre-finance act, that is how it is being done. Year of assessment, the 1st of May 2018. Okay. Now, what is going to happen here in your accessible profits? Accessible profits is going to give me what? Accessible profits is going to give me 12 months now. I'm going to do the same thing I did here, but it's going to be 12. It's going to be, yeah, it's going to be 12 months of this addition of these two. All right, so we're not prorating. So it's going to be 1,540,000 plus 132,140, 132,140. We're not prorating. So 1540 plus 132. Oh, so sorry. 1,540,000 plus 132, 140. That gives us 1672, 140. So that's it. Then we'll come to capital allowance. So this is part 2. What we calculate was 1, capital allowance due. 2. Let's calculate that. So let's go now. So you are entering year of assessment 2018. So this is for 2017. So what we have here now is tax written down value. So what do we have in tax written down value? We have here 1,250,000 minus 625,000 minus 91,146. That will give you 533,854. 533,854. 533,854. Okay, so the next one here is 142,500 minus 712,500 minus 103,906. And that gives us 608,594. 608,594. The third one is going to give you 1,890,000 minus 283,500 minus 93,713. That gives us 1,512,787. 15,12,787. Now the last one will be, I think it's 920. Okay. 920,000 minus 138,000 minus 45,617. That gives you 736,383. All right. So we will not calculate initial allowance because we didn't buy any more. We'll just calculate annual allowance. Now, in the law of capital allowance does not allow overlap or gap. It doesn't. Going back to your year of assessment, the basis period, let's compare. Now we have June, 1st June 2017. It's also here. 31st of December 2017. It's also here. So what is not here, the addition here is January to May. January to May. which is 5 months. 7 months is overlap. The remaining 5 months is not overlapped. That is the only 5 months that will be for the capital allowance, because we have already charged 7 months, which is common to them in this 2017. We cannot charge it twice for capital allowance. So you've charged that period for 2017. The remaining 5 months, which is the one that did not lap, is what we are going to take. So it's going to be 5 months. So we'll come back here and we'll calculate our capital allowance again. How we calculated before, we said we have 1,250,000, which was cost, and we minus initial allowance 625,000, and we got 625,000. When we divided it by 4 years, this is what we got for 1 year, 156,250. Now we want to take 5 months out of it. So we simply say times 5 divided by 12. So that's going to give us 65,104. 65,104. So this is going to be 65,104. Okay, so the same thing here. Let's take it. When we take this cost minus this, it's going to give us the same thing because it's 50%. So we have 712,500, which is the difference between the cost and the initial allowance. It gives us this. So let's divide it by 4 years. That will give us 178, 125. That's for 1 year. We're going to take 5 months out of it. Times 5 divided by 12. So we have 74,219. 74,219. That's it. The next one here, we'll do it. One 1,890,000 minus 283,500. This is what we are supposed to charge as capital allowance for the whole 10 years. Let's check for 1 year. Divide by 10. This is for 1 year, 166.50. Now let's check 5 months out of it. Times 5 divided by 12. That gives me 66,938. 66,938. Okay. Now the next one here is going to give us 920,000 minus 138,000. That gives us 782, which is going to be divided by 10 years to give us 78,200. We are going to look for 5 months out of 12. That will give us 32,583. All right, let's look for the total. So we start all over. We have 65,104 plus 74,219 plus 66,938 plus 32 583. That gives us 238,844. 238,844. 238,844. So this is your capital allowance for the period. That's your capital allowance for the period. 238,844. I'm going to take 238,844. So what I will just do is to less it. So what I will do here, to 140. That will give you 114.33. 14.33, 296.
Hello, sir.
14.33, 296. Yes?
But there is a capital allowance brought forward from the previous year.
I didn't get that.
There's capital allowance brought forward from the previous year. Are we not going to use that?
Oh, did we miss it? Wow, so sorry. Okay, yeah. Thank you for that. Thank you for that. Thank you for that. So let me just bring this one here. 238,844. I totally missed that. Thank you for being sharp. I'll come again. Capital allowance brought forward. Capital allowance brought forward is 1,260,467. All right. So let's add them up together. 238,844 plus 1,260,467. That gives me 1,499,311. 1,499,311. Okay, so this is capital allowance claimable. So how much capital allowance can we claim? Capital allowance claimed. We are going to claim everything, but it's smaller than this. 1,499,311. We're going to claim everything. 1,499,311. Okay, so no capital allowance is carried forward. Your total profit will now be, so let's remove this from 1,672, 140. That will give us 172,829. 172,829. I would have written it here. 172,829. Let me clean this one here. All right. So that's your total profit, your company income tax, is going to be 30% of total profits. Just multiply by 0.3. That gives me 51,849. 51,849. And your tertiary education tax at 2% of accessible profits. Accessible profits 2%. So 0.02 multiplied by 1,672,140. 33,423. 443, I mean, 33,443. All right. Then we go to the last year, which is going to be 2019 year of assessment. What we just did now was 2018. 2019 year of assessment, the basis period is going to be the account year end. We wrote them somewhere, 1st June 2017, 31st May 2018. The same thing. So what we are going to do now is 1st June 2017 to 31st May 2018. The same period with the second year. So what we're going to do now is accessible profits. It's going to be the same thing we got here. 1,672,140. 1,672,140. Okay. Your capital allowance. Okay, we don't have anyone carry forward, so let's say due. And let's go back and do it here. We'll come here. Year of assessment 2019. So let's do it now. 533,854 minus 6,5,104. That will give you 468,750. $750. Okay, so the next one will be 608,594 minus 74,219. That gives me 534,375. 534,375. And the next one will be 1,512,787 minus 66,938. That gives me 1,445,849. All right. The next one, someone is asking a question. Is this okay? Is there capital allowance brought forward? We cannot be calculating capital allowance here brought forward. We are calculating tax written down value. Sorry.
No, Mr. Chima, I put the question first before I called your attention.
I didn't get that.
Hello?
I didn't
That
get that.
question was put before I called your attention to it. It was for the previous year that we were calculating. Yes, it's not a new question. I put the question there first before I called you.
All right, so sorry.
Yes.
All right,
Okay.
so let's look at this one now. It's going to be 736,383 minus 32,583. That gives me 703,800. 703,800. So let me do it properly. It's supposed to be tax written down value. So let me properly write it down here. Tax written down value going to be 468,750. It's going to be 534,375. It's going to be 1,445,849. This is going to be 703,800. So with that, I can wipe this slate clean here. It's not supposed to be on top here, not to cause confusion. All right. Now, annual allowance. Now, we said annual allowance for capital allowances observe. In fact, capital allowance, then you have to adjust for gap and overlap. When there is a gap, you address it. When there is an overlap, the overlap belongs to the previous period. Now, 2018 and 2019 are exactly the same, exactly overlap. And that means that the basis period we are calculating for 2019 is the same as 2018. And so there will be no capital allowance for this year. There will be no capital allowance for this year. So your total capital allowance will be nil. It is from 2020 that you are going to now give the full year capital allowance without prorating. Remember in 2018, we prorated for 5 months. 2019, we gave no capital allowance because it is the same basis period as that of 2018. And so we'll just go here. There will be no capital allowance here. Capital allowance due dash. There is no brought forward also. And so this is going to give us total profit to be 1,672,140. So your capital, your CIT at 30% total profit. Let's calculate that. 1,672,140 times 0.3. That gives me 501,642. So that is 501,642. And then your tertiary education tax at 2% of accessible profit. We've calculated that before, which is 33,443. And that's how we come to the end of this question, because the relevant years of assessment, we said, is from 2017 to 2019. So suffice it to say, when you are giving pioneer business, there is a calculation. What they are testing you is basis period. The real pioneer business is this first one you've done, which is this one here, by noting when the pioneer business will start and end, accumulated profit and all that, and to have the remembrance that your capital allowance is not charged, it's taken as if it is bought on the new day of the new business. That is pioneer. So that's why we need to learn our basis period, our commencement rule, our cessation rule. Sometimes a business can be ending in order to start a pioneer business. We will need to use the cessation rule to deal with that. So pioneer business is always an irregular occurrence, and know that you are going to be dealing with basis period. That's a way to test basis period. There is another way we will need to learn to test basis period, which will be handled in another topic that will come up after this. So suffice it to say now that in part 1, we learned the theory part in case it comes out of pioneer legislation, how it is being dealt with. In part 2, we are seeing the calculation, which makes us to know that we are being tested for commencement or cessation rule. It could be your Finance Act 2019 rules that is being tested. It could be the older version. So you please go back and learn your commencement rule, the cessation rule, the change of accounting date. These are the building blocks of your knowledge in taxation. When you get that, every other thing is in the bag. So thank you so much for being attentive here in the class. I will see you in our next class when we'll be discussing a new topic that will be of interest to you. Thank you so much once again. And I'll say here, good night. See you next class.